We have all met the investor at the cocktail party who found a stock that exploded 5 times over and wants everyone to know it. This approach treats the market like a game of chance, where chasing the thrill of a hot tip takes precedence over the realities of risk. The financial industry often reinforces this behavior. Brokers and advisors frequently push heavy equity allocations because the commissions for selling stocks are significantly higher than those for government securities or gold. This chart shows the result of that bias in the Indian market from 2010 to 2020. Despite a decade of extreme volatility, equity returns compounded at just 8.5%, virtually identical to the return of a standard risk-free fixed deposit. Following individual stock tips and maintaining pure equity exposure leaves a portfolio structurally vulnerable. You're carrying all the downside of the market without the historical surplus in returns required to justify that risk. A truly resilient portfolio functions just like a massive load-bearing structure, specifically engineered to withstand sudden external market shocks. Financial research indicates that between 85 and 90% of your total investment returns are determined strictly by how you allocate your assets across different classes. In 2019, for example, traditional Indian equities in the Nifty 500 delivered a modest 7.7% return. During that same period, other asset classes significantly outperformed. Government treasury instruments rose 9.5%, while gold prices climbed over 24%. Even within an equity portfolio, buying a collection of hot tips often leads to hidden sector concentration. If those stocks all belong to overlapping industries, a single downturn in that sector can pull down your entire net worth simultaneously. True diversification requires the deliberate balancing of distinct asset classes and sector weights to ensure the portfolio does not fracture under localized pressure. Investors often overlook SCCARS, the risks associated with being tied to a single country, currency, and asset class. The Indian market represents less than 3% of the world's total market capitalization. Restricting your investments to a single domestic market means ignoring over 97% of global wealth. Domestic concentration also carries significant currency risk. Between the 1980s and 2023, the Indian rupee depreciated by over 85% against the US dollar. While currency depreciation acts as a slow drain, heavily concentrated domestic portfolios face much faster, devastating risks from sudden systemic market shocks. During the 1997 Asian crisis, investors in Southeast Asian nations saw their markets fall between 50 and 90% in dollar terms. In Indonesia, some investors saw 90% of their net worth vanish in a single year. Global diversification means seeking out international markets with rotating leadership. It requires more than just adding a single U.S. technology index to a domestic portfolio. Keeping your capital trapped within a single country's borders creates a mathematical guarantee of exposure to localized systemic downturns. Every other strategy is secondary to risk management, the most critical factor in long-term financial survival. Human psychology makes this difficult. Our biological loss aversion bias often leads us to hold on to losing positions because we are unwilling to admit a mistake and realize the loss. But the mathematics of a market crash are asymmetric. If a $100 portfolio loses 50% of its value, it drops to $50. To get back to your original $100 from that $50 baseline, you don't need a 50% gain. You need a full 100% gain just to break even. Ruthlessly petting losses is the mathematical prerequisite to ensuring you have enough capital remaining to participate in the next market move. Effective investing requires a shift in identity, away from the emotional pursuit of stock tips and toward the methodical work of an architect. The core framework is straightforward. Implement deliberate asset allocation, balance your sectors, diversify globally, and prioritize risk management above all else. Generational wealth is not built through occasional high-growth stocks, but through the mathematical engineering of a portfolio built to survive.